This is our Forex blog for November 17th, 2011. And like most days, we really want to buy the strongest currencies versus the weakest and sell the weakest versus the strong. Yesterday was more of a counter trend day in that the strong currencies from about 2 to 5 had some weakness and then a lot of intense weakness and weakness. And of course, last night started off with quite a bit of weakness as well. One of the reasons why we show underneath the real-time strength and weakness, the daily, the weekly, and the monthly, is because once the currency is done pulling back, buyers come back in if the longer-term trend is up. If the longer-term trend, the weekly, monthly, is strongly up, then there's a reason for that. So after enough of a pullback, when there's a bargain, think of trading currencies as an auction process. It's kind of like a sale at a retail store. When there's a good enough sale, then buyers come back in and, the longer term trend frequently continues. You can see today the Australian has a weak daily, weekly, and monthly trend. The New Zealand is even weaker. The weekly, monthly trend is much weaker than this. The Swiss is also weak. So these are the three weakest ones, and the dollar and yen are both strong on all time frames. So if, like for instance, at 2 right here, you saw incredible strength in the yen, a lot of strength in the dollar, but a little bit less strength in the yen, then, trade the yen against the weakest ones. 2, we have quite a bit of weakness followed by very little strength. So at 3 o'clock, it's pretty much likely to go down again. Now, the yen had a little bit of weakness for 1 5-minute period, and then that kind of fell off right here. But still, you're looking to sell the New Zealand yen around 3. You might get into a trade where there's a loss, and then the next trade is a win. So here's the New Zealand yen. First of all, price is above the hourly, and that means it's more likely to go up than down. It comes back down and breaks underneath the hourly. And again, usually when a currency breaks from above to below or below to above, it does a retest. Like you can see here, it broke down, did a retest. You might have even, if you're aggressive traders, sold here. And again, you might have had a loss. If you had a super tight stop, you might have just got tricked out of this trade here. But once, again, we're looking at 3 o'clock to sell it, comes back up, can't get above these highs. You go short right here around 97, and you can see it pull back about 20 pips. It wasn't the best trade in the world. However, using the currency meter like this, when you have extreme strength followed by very little weakness, if the longer term trend is up, the previous momentum, which is up, is likely to continue. Here, comparing the yen to the dollar, the dollar had quite a bit more weakness here than the yen. So coming up, once this kind of fell off right here at 430, it's very safe to assume that the yen's strength will continue. And it does, and it doesn't continue with as much intensity as the dollar does, because you never know what the future is going to hold. But even if you catch a 5 to 25 pip move versus a 30 or 35 pip move, and take the trades in the highest odds. Let's look at that New Zealand yen again at 430. Notice the currency made a lower low. It came back up, 430 right here. You might be short at 88, and it came back down and hit the lower previous day's low, which was also the low here. So it's about a 15 pip profit. Sometimes you're going to catch 30 and 50 pip moves, and other times, not so much. Let's look at the Australian, which was also weak. From 4 to 5, a lot of weakness right here, followed by about an hour of about half the intensity strength. That trend is very likely to continue because the longer term trend is down, coming up to 6. And at 6, the dollar had quite a bit of weakness, so I would always prefer to buy between the two currencies. If they're both strong before, the one that has the least amount of weakness, I would prefer to trade myself, because I'm more about trying to have as high a winning percentage as possible. You never know what the future is going to hold, but a lot of times you catch the biggest moves by trading the one that was strongest before, and then during the pullback phase, it had the least amount of weakness. So this coming up to a little bit after 6 right here, you'd be looking to trade the Australian yen as well. So let's bring this up. Now this is a wonderful trade because in this currency, it broke underneath the hourly moving average. And so when it comes back up here's actually 6 o'clock right here. As it comes back up and fails to stay above the previous day's low right here, you have a great short here at 45 when it breaks these bars low, and it comes all the way down to 24. So it pulls back about 20 pips. Today's a relatively dead day, and most people are going to use our range charts rather than regular 5-minute charts. It allows you to have a smaller loss when you're wrong, and it also allows you to get out of trades like in the Australian yen here. During dead days like this, let's use let's just say 6 pips per bar, 6 range bar chart, 6R. Put that in there. I'll put this on layer 8 so it shows up on where the current one is. And hopefully my eSignal connection is good. Sometimes when you leave the software running all week, it has a problem downloading a huge amount of tick data. We'll see if this comes in here. I can always open up a new eSignal just to show this. Most people reboot the software every day. Okay, here it goes. It came in. Took a while. It is a lot of data to ask for, and I made the mistake of asking for 6 days of tick data. When you're trading today, you don't need 6 days of tick data, which is every single price change throughout the day. So it's literally downloading 100,000, 200,000 pieces of data to calculate this, and that's unnecessary. So looking back at this, at 6 o'clock, we're looking to sell. Let me zoom back in here. And it also gives you a better entry and also tighter stops. So here you would have gone short. You would put your stop right above this bar's high by 1 or 2 pips. And as it's coming down, typically what I do once it starts going my way is I move stops above each bar's high. It comes down here, just barely broke this low right here. You can see it had many opportunities to break it, and it failed to. You probably would want to exit half your trade here at some point when it doesn't break down. So you're up about 14, 15 pips on the first half, and I'd put my stop above these bars high. Today is not one of those days that just keeps trending and trending and trending. So you got to take whatever you can get. If you make 10 pips on one trade, 14 or 18 on the next, lose 6. On days like this, it's very critical to have the tiniest losses possible. So let's look at the pound. The weekly trend was down until about 4:30. The monthly trend is slightly up, and you can see that each peak momentum move was to the upside, followed by significantly less weakness, less weakness, less weakness, less weakness. You certainly can on days like this, when the dollar and yen pairs aren't really moving a considerable distance. You certainly can trade the pound versus one of the weakest ones. The Australian, the New Zealand, buy pound Australian, buy pound New Zealand. Let's put this back to a 5-minute chart so we don't have to wait so long. And notice, the trend direction all day. And in some of the clearest signals here, 1 bar of strength doesn't matter, but an hour worth of strength with 3 or 4 of the bars at and above the 80 level, followed by 15-minute pullback here at 4. That's a pretty much no-brainer. 4 o'clock, you got this little pullback right here, and you can see this one actually went up quite a bit more than the other pairs that we looked at in terms of pips. You draw your Fibonacci areas, and this is an excellent place to get out of a trade. 56.68, and you'd be long right here at 56.26. It's about 40 pip move. It's a phenomenal trade right there. 40 pips. And again, once you get pullbacks, here the market made a higher high, pulled back. You might have went long right here. Using a range chart, you would have had probably a little bit more precise entry, maybe somewhere around here, 34. It went up, wasn't able to even reach the highs. You always want to exit half your trade if it can't get back to the highs relatively quickly. And then the second half of the trade, you might have got out down here for a very small profit. And again, sometimes markets take about a half an hour to 2 hours of sideways consolidation before they go higher. As this breaks out right here, you have the fib target of this wave to look for. You have also the fib target of this little mini wave. And so, always be aware of where these areas are. If it goes to one of the fib areas and kind of stalls, you want to exit half. You might have been in this trade here at 51, out of the first half at 81 for 30 pip profit. But the currency meter really shows you which type of currencies you want to trade. The New Zealand, I think, was weaker than the Australian. So let's take a look at this one. And you can see, not much of a pullback right here. It went up, pullback, went up, a little bit of pullback, went up. Here you have a nice little 2-hour sideways breakout. And typically you want to buy the breakout of the highs, but if it's right here at 45 and you can buy the breakout right here at 36, 9 pips earlier, you have a tighter stop. Because remember, your stop is always underneath the swing low by a pip or two. And anytime a currency goes sideways for about an hour or two, it typically is going to break out if it's as strong. So you got your fib target off of this wave to look as a profit target, and you can see it really ran into quite a bit of resistance here for an hour and a half. Wasn't able to go lower, and it shot up again. Always draw your fibs on the last wave if you decide to stay with that trade. This is a very high probability reversal area it's at right now. It's also gone up significant number of pips. One of our tools, which I don't show in our blog that much, but I will right now, is our range tool. Get a range projection, and you can put 240 minutes or hourly or even 1440 minutes on here. Most of the time, the 4-hour range high is where the market goes to and stalls. It's an excellent profit target. And if you want to know how far a currency moves normally during an entire day, there's 1440 minutes per day. Just put that in there. And frequently, the average high and low on a daily basis is where the market stalls. Let's put this on here. You can see the price is slightly above that area right now. Most times, if you look back on past days, the market doesn't move beyond that. This is an average amount of pips per day to move. So right now the market's moved a little bit more than is average for the day. And if the momentum kind of ran out of steam, you can certainly consider doing counter trend when it's up here. This one's strong and it's probably not likely to reverse right now, but the next wave up, if it gets up to the fib targets of this, is pretty high probability, probably 70 or 80% in my opinion. As long as the statistical momentum isn't that strong, you could sell that next wave up and probably catch 25 to 50 pip pullback.